You probably believe your money stays safely inside your bank account, that when you deposit money, it simply sits there waiting for you. But the truth is very different. The moment your money enters the bank, it begins moving through the financial system. In this video, you'll discover where banks actually send your money, how savings accounts really work, and why banks depend on your deposits more than you depend on them. Let's start with a simple but shocking fact. When you deposit money into a bank, that money is no longer legally yours. It becomes the bank's money. In exchange, the bank gives you a promise that you can withdraw it whenever you want. This system works because most people never withdraw their money all at once. Many people imagine banks as giant vaults filled with cash, but modern banks don't work like that. Banks operate on something called fractional reserve banking. This means banks are only required to keep a small portion of deposits as cash. The rest is used for lending and investments, so your savings are not sitting idle. They are actively being used. Here's what banks do with your money. They lend it out. Your deposits help fund home loans, car loans, business loans, student loans, and credit cards. When someone takes a mortgage, part of that money likely comes from people's savings accounts. Your money is working, just not for you. Now let's talk about how banks make money from this. Banks pay you a small interest rate on your savings, usually 1 or 2%. But when banks lend that same money, they charge much higher interest, sometimes 6%, sometimes 10%, sometimes even 20% or more. The difference between what banks pay you and what they charge borrowers is called the interest spread. That spread is one of the biggest profit engines in banking. So, why do banks care so much about your savings account? Because deposits are power. The more deposits a bank has, the more money it is allowed to lend. Every dollar you deposit gives the bank the ability to create multiple dollars in loans. This is why banks offer sign-up bonuses, high-yield savings accounts, and constant promotions. They are not doing this to help you. They are competing for fuel. Your money is the fuel. You might be wondering something important. If banks lend out most of the money, what happens if everyone asks for their money back at the same time? The answer is simple. Banks wouldn't be able to pay everyone. Banks do not keep enough cash to cover all deposits. This is why governments provide deposit insurance, and central banks act as emergency lenders. The system survives on trust. As long as people believe their money is safe, the system continues to work. This also explains why bank failures cause panic. When trust disappears, people rush to withdraw money. And when withdrawals accelerate, even strong banks can collapse. Banking is not just about money, it's about confidence. So what does this mean for you? It means your savings account is not just storage, it's participation. Your money is constantly being lent, reused, and multiplied throughout the economy. You earn a small return, while banks earn much more. This doesn't mean savings accounts are bad. It means you should understand how they actually work. The biggest mistake people make is believing banks exist to protect their money. Banks exist to use money. Your savings account is one of their most valuable tools. Understanding this system changes how you see money, debt, and banks. And in the next episode of this series, we'll explain how banks create money out of nothing and why debt sits at the center of the modern financial system. This is Money Mechanics, where we break down how money really moves.